One of my viewers recently pointed out that I hardly ever show homes that have already sold. I'm always just showing the listings that are for sale and talking about the price cuts and this and that, but what about the properties that have actually sold? Well, good point. And mainly the reason for that is usually because when I walk by, you can't really tell at first glance if the house just sold. But I happened to see this one just now, and this house recently just sold in July of 2022, and they sold this place for $1,150,000. It is a 2-bedroom, 2-bath home, and it's about 2,000 square feet. And then they listed it for rent back in September for only about $5,300, $5,500 a month. And it looks like it's still pending, whatever that's all about. So I don't know if they got a tenant here or what's going on. That seems like a pretty low rental price for paying that much for a house, but here we go, guys. We have one that sold. There was a story today about this couple that had no clue that when you buy a house and you have a mortgage on the property, that not only are you required to have insurance at all times on the property, that is part of your mortgage agreement on the property, but they also did not know that if you fail to provide your own insurance on the property, that the mortgage lender will go ahead and get a policy on your behalf. And the thing is that, and the reason why this couple did not get insurance on their own is because when the renewal bill came up, it was very expensive. And they said, oh, we can't afford this, so we're just not gonna pay for it, basically. And then to their big surprise, they see that their mortgage payment went up substantially. And I wish this story would have mentioned the dollar amount difference that it actually went up for them, but it didn't, unfortunately. But what happened is their mortgage payment went up quite a bit due to this higher insurance costs that their lender got on their behalf. And this type of insurance that we're referring to here is called forced place insurance. And the crazy thing about this type of insurance is a lot of times your lender could actually have financial ties to the insurance company that they choose for you, and basically not only stick you with a much higher cost policy, but actually the policy will work way more in favor of the lender than you as the homeowner. And if you decide to keep this type of insurance, what will happen is later down the road, if you ever go to make a claim, you could find out that a lot of things that would be covered under a normal insurance policy are actually not covered in situations like this. So you really got to make sure stuff like this doesn't happen to you. I was surprised to learn that there's even people that don't know that you need to have insurance when you have a mortgage. So the short answer to that question is yes, guys. If you have a mortgage on your property, more than likely, basically 100% of the time, you're required to have insurance on the property. So make sure that if you get a renewal bill for your homeowner's insurance and it looks like it's too expensive to pay, you need to shop around for a different policy and get the best deal that you can. Because if you don't, your lender's going to purchase one of these forced place policies on your behalf, whether you like it or not, and it's going to cost you more and protect you less. So it's one of those situations that's a lose-lose for the homeowner, and you're better off taking insurance from any company you can get it from that's cheaper versus keeping a policy like this in place. And the good news is, if something like this does happen to you, where your lender puts in a forced policy, then you still have the right to shop for your own insurance and cancel that policy once you actually find something that's more suitable for you. So if this does happen to you, it's not like it's too late. You can go out there and find a better policy that's a better fit for you. And once you have that, you can have the insurance company send the notice directly to your lender, and you can then cancel this forced place insurance. But this is just a huge heads up for people, because it basically reveals a couple of things. One, homeowners insurance is going up, guys. That's something that everyone needs to be aware of, especially if you live in places like Florida or in certain parts of California where there's risk of wildfires, and anywhere you live where there's a high probability of natural disaster, or there's a lot of claims in your area for flooding or whatever it might be, then there's a good chance that insurance is going to be going up for you next year, along with property taxes and everything else. So first of all, make sure you figure out how much things are going to be going up by, and make sure you can afford this, because that's going to be factored into your new monthly mortgage payment going into next year. And as a precaution, you could maybe just make sure your mortgage lender has received the insurance update that you have paid, and your policy is going to be in effect, because the last thing you want is there to be some sort of miscommunication between your lender and your insurance company, and then they go out and purchase one of these policies without you knowing about it because of a simple mailing error or something ridiculous like that. So watch out for stuff like this. This could be happening to a lot of people coming into the new year. And after all this insurance talk about how much insurance might go up here in Florida and what might happen with this after Hurricane Ian this year, one thing that I was concerned about is how much my own insurance was going to go up. And I have not received my homeowner's insurance bill yet for 2023. I probably will sometime early next year, because I think it's not due until February, something like that. But anyways, I'll keep you guys posted on that. And one good thing is car insurance is susceptible to all these insurance premium increases as well, even from natural disasters like Hurricane Ian and things like that. And I was worried that that was going to go up substantially, even though I haven't had any claims, and it did go up, but luckily not nearly as much as I thought it would. So that's a good thing. It's definitely still within the realm of affordability. I think it went up maybe like $80, $70, something like that. So not too bad. Then that's for the whole 6 months too, by the way, because I pay the 6 months up front to get the maximum savings. So, because I pay all of it in advance, you end up getting the most savings and the least amount of increase. So I was happy to see that. But not everybody is so lucky when it comes to rising insurance costs, and Florida developers are the next ones who are on the chopping block, because they are seeing big increases in their insurance premiums for risk insurance, something that they need to have when they're developing new properties. And some developers are seeing increases as high as 30%. And when they talk to some high-rise developers here in South Florida, they said that sometimes risk insurance for building one of these high-rises can cost as much as 8% of the entire cost to develop the property. So it is a pretty large portion of the development costs of one of these high-rises here in Florida. Only about 3 years ago, those costs were only about 2%. Within the time frame of 3 years, insurance costs for developers has literally risen 4x, guys. That is huge, and obviously is going to add to the cost of real estate down here in Florida in particular. But I would imagine this is not just a Florida problem. I would imagine that this is an issue pretty much anywhere there's a lot of development going on, and this is just another thing that's going to add to the cost of housing. Because the problem with this, a lot of developers are unaware of just how much these insurance costs have gone up. When they budget for these projects, they're basically under budgeting how much the insurance cost is actually going to be, and it's causing a lot of them to actually cancel the deal and no longer move forward with the development because the insurance is too expensive. And the insurance companies are claiming that they're getting hit from both angles on this. They're saying that not only have the amount of natural disasters and the severity of natural disasters in Florida had an uptick in recent years, but also because there's not that many insurance companies left in Florida, they have a lot more risk exposure to the markets, and if they insure too many of these projects at once, their risk profile goes through the roof for these insurance companies, and it basically forces them to charge extra for these things. On top of all of that, a lot of developers are being sued in recent times for construction defect litigation. So if you're out there looking to buy a new construction property, this is definitely something to keep in mind and to watch out for, because you can almost guarantee that these costs are going to be added to the bottom line of the developer. And so because these costs could be added to the price, the final price that you pay for the property, this is probably just going to continue to make housing more expensive in Florida, at least for new construction. However, The one ace in the hole that people have is there's still a lot of housing being built down here in Florida, and there's still a possibility that you could get a decent deal as more developers need to unload these properties, because right now is such a terrible time for people to be out there buying. You know, these guys are desperate. They're offering all these incentives like we talked about before. They need to get people in the door. And I would imagine many of them would even start selling at break-even prices just to get out of the property, because holding on to it long term would be even more detrimental to their business. Here's another new trend we're starting to see emerge in the housing market, which is that 1 out of every 50 listings is now starting to get removed from the pool of available inventory out there in the nationwide housing market. The number has been steadily going down throughout November, and one of the reasons supposedly behind why so many listings are coming off the market recently is because a lot of sellers are just not getting the price that they were hoping to get when they initially listed the property, and they're starting to come to terms with and realize that the run-up on the housing market is over. A lot of these sellers have either received no offers on the property or have received too many lowball offers that they're not going to consider, and combine that with the fact that it's the end of the year, the holidays are here. A lot of people don't want to walk in through their house when they have all the holiday events going on and the decorations and this and that. They're taking listings off the market. And I would argue that that happens basically every year. This is not something that's exclusive to 2022. Typically, you see way less home buying and home selling activity at the end of every year. I mean, this is always my slowest time of the year, and all of the years that I was doing real estate, pretty much in December, have almost nothing going on. And that was pretty much normal every year. Here's where things just get ridiculous and greedy. This house was sold for $1.3 million back in March of this year. Then they turned around and sold it for a loss, probably tried to flip it. They sold it for $1,115,000 just to get rid of it. And now the new guy thinks he can flip it again for significantly more at $1,750,000. This is the ultimate tale of greed, and this is just insanity, guys. I hope that they just get stuck with this property, because this is just nuts. And here in Florida, for example, a lot of the major cities have seen a noticeable decline in the amount of listings being removed from the market. Like in Fort Lauderdale, 1.6% of the listings have been removed. Jacksonville, 1.9%. Miami, 1.9% have been removed, Orlando 2%, Tampa 1.9%, and West Palm Beach 1.7%. And you have other areas, especially on the West Coast in California, that have seen even bigger numbers of listings removed. Like in San Jose, California, for example, they've had 3% of their listings removed. San Francisco, 3.4%. Oakland, 3.3%. But here's the thing, guys, and here's what's going to happen. I can pretty much guarantee you this. This article that I'm pulling this information from pretty much backs up my claim on this as well. They say usually sellers who pull their listings off the market in the fall do it with the intention of listing again in the spring. Now, this is the key part of the information here that everyone needs to remember from this. We talk a lot about having patience and waiting for the right time to buy, and this is the perfect example of this. Now, first of all, if you ever find the right deal and you know you can afford it, whatever, you go for it whenever the time is right for you. But for people that are unsure on what to do, this is basically a huge signal that there is going to be a lot of new inventory come spring of 2023, because a lot of people who have tried to sell their house now when they thought that they could still get peak market prices, and they're now realizing that the party is over, they're thinking, well, I'll take it off the market for the holidays and wait this out a few more months, and then we'll try again in spring, because the mentality is, well, in spring, that's when the market's hot again, and a lot of home buyers come out in the spring, start going to open houses, start looking for a place to move come summertime, which is true. When you look at traditional real estate activity, spring is probably one of the hottest seasons of the entire year for people looking to buy a home. However, because we are headed headfirst into this recession right now, and less people are going to be able to afford to buy than ever starting the beginning of 2023 due to interest rates remaining extremely high and home prices still way too high, What is this going to do? Well, it's going to have all these sellers that think that waiting until spring of 2023 is going to bring a better situation. They're actually going to make a better situation for buyers, because if enough of them start listing all at the same time in spring with that same mentality, I'll take it off the market now, try again later, what that does is it creates a ton of new inventory on the market all at the same time. And that's exactly what the housing market needs right now. And so this could end up being very good for people starting at the beginning of next year. And that's why I'm getting back to the point time and time again that patience, guys, like just a few more months. I'm not saying you're gonna see half price listings by then, but what I am saying is within the next 3 to 6 months, you're gonna see a lot more inventory on the market available for sale. And because there's more inventory, sellers will have to get more aggressive and more competitive on their pricing in order to stand out and actually get their property sold. So look out for this come spring of 2023. And of course, when the time gets closer, we will talk more about it and cover that. We got a beautiful friend right there. Look at that peacock. Such a beautiful bird, and it is huge. It's very big. Very calm, just walking through the neighborhood, just foraging food around here, people's yards. Very cool. Now, because housing in general is still very expensive, a lot of people are probably still struggling with the dilemma of, do I rent or do I buy? And sometimes the decision is very obvious on what to do, and sometimes it's not. You know, my rule of thumb has always been basically very simple. If it's cheaper to buy than it is to rent, then you should buy. I mean, on a very basic level, that's how it should be viewed. However, it's not really that cut and dry for most people, because a lot of times in order to make buying cheaper than renting, you need to come into it with a substantial down payment, sometimes 20% or more, on top of the fact that you really know your market and know that the area you're buying in has rental prices that exceed what it will cost to buy. And housing has gotten so expensive in the recent last couple of years that 47 out of the top 50 US metros that are tracked say that it's actually cheaper to rent than it is to buy right now, but with a caveat. And I want to bring this up because it's an important thing to think about when you're looking at buying. And they say that when you're just comparing apples to apples, the actual rental cost to the cost of buying the property, which they're taking into consideration the actual mortgage payment, the property taxes, the insurance you have to pay, plus potential repair costs. And they're basically comparing that and saying that for someone who bought a $205,000 starter property and they put 5% down and their interest rate was about 6.9%, then it would bring their total monthly in principal to $1,283 a month, plus an estimated $662 a month in taxes, mortgage insurance, and homeowners insurance costs. And that brings the total home buyer's payment to $1,945 a month. And basically, for the example in this article, they're using the median rental price in Chicago, Illinois as the example here. And so the monthly median rent in Chicago right now is $1,356 a month. And so right off the surface, it makes it look like renting is better than buying, because renting is significantly cheaper in this situation by about $600 a month. But what they're telling people is that you also need to take into consideration the amount of equity that you build up over time and actually subtract that potential gained equity from your home ownership costs. So if you're paying $1,900 a month and you're gaining $600 a month in equity, they're saying that your true cost of owning the property is actually $1,300 a month. My beef with this situation is this: when you look at your monthly budget, there's no denying the fact that $1,900 a month is more than $1,300 a month, okay? Now, you are gaining that equity, and they're going by a 3.8% increase in equity per year, which is basically the national average over a certain given amount of time. Okay, but here's my big couple problems with this. When you buy, your actual monthly budget is quite a bit higher in this scenario, $600 a month. And even though you might be getting that in equity over a period of time, over the years you own the property, the issue is that a lot of people, especially first-time home buyers, do not buy a property and own it long enough to essentially realize those gains, especially right now when we're in a down market, when a lot of prices in different areas are falling. This can totally backfire. And so if you want to realize that $600 a month gain when it comes to renting versus owning, and actually see some benefit from this and light at the end of the tunnel, then you really need to make sure that you're in it for the long run when it comes to purchasing the property. And I'm talking 10 plus years, guys, no joke, because that basically gives enough time as a buffer for you to realize some substantial gains in equity, because you got to remember, especially during the first 10 years, you're paying a lot more towards interest than you are towards your principal payment of the loan. So you're not gaining as much equity as you could be just through your mortgage payments, and you're relying more on market appreciation at that point. And if you're heading into a down market like now, you could end up 10 years down the road, not having much more equity than you started with. So this plan only works when people hold the property long term, 10 plus years. And this also assumes that in 10 years, the house is worth more than it was when you paid for it 10 years ago, which typically it usually is. I mean, 9 times out of 10, it's going to be, unless the timing is just terrible, or you bought in an extremely economically depressed area, something like that. So yes, technically, owning could end up being the better bet in the long run, guys. But that's the thing you got to remember. In the long run is the key phrase here. So if you're not in this for the long run, renting highly likely right now would still be cheaper. But you need to run this calculation for yourself and basically determine, if renting is going to be a better deal or buying will be. And one more goodbye to our friend the peacock here. It's been following me around basically. If you guys enjoyed this video, make sure you hit the bell notification down below. YouTube will alert you every time I put out a new video. And if you don't want to wait, check out my next video on the screen right over here, and I'll see you in the next one.